And I also hope that you brought your life jackets because we're going to be talking about a port in the storm, strengthening financial customer relationships during economic uncertainty. And I have the pleasure of welcoming Robbie Freeman.
And you should expect a lot more boat puns as we go along. So how many of you have ever gotten seasick on a boat before? By a raise of hands. Oh, I see some in the audience. It's a frustrating experience. You're ready to enjoy a sunny day, and bam, you're huddled in the corner, chugging water, hoping for that nausea to subside. For consumers and marketers alike, that's what our current economic environment feels like. Economic uncertainty is the new normal. From trade wars, inflation, and softening job market are affecting consumers' day-to-day spend and their relationships to their financial institutions. I'm Robbie Freeman, Director of Strategy here at Movable Inc. And using my 12-plus years of FinServe marketing experience, I'm here to captain this ship and help you navigate how FinServe marketers can strengthen their financial relationships with customers during these times of economic uncertainty. There we go. First, we'll set sail to understand the economic conditions that have led us to this point, along with how other captains are responding to the challenges that they're facing. Then we'll take a look at how these conditions are impacting consumers. From there, I'll show you examples of how marketers like yourself across various financial service verticals are maximizing their relationships with consumers in these turbulent times. And by the end of this presentation, X will mark the spot, and we'll be ready to take action on your marketing programs. See, I told you there'd be a lot of boat puns. So let's set sail. First up, how do we get here? Exiting 2024, it appeared that clearer skies were ahead, and we could finally stop thinking about things as post-pandemic and simply everyday life. Interest rates had declined. Inflation continued its downward trajectory, and most importantly, consumer optimism was strong, fueling 2025 spend plans for essential and discretionary products alike. Alas, this optimism was short-lived, and it appears that storms were on the horizon. The key challenge, the United States' shifting policies have led to economic uncertainty around the world. Broad tariffs implemented against all US trade partners are generally expected to boost inflation as many retailers pass along the added cost to consumers, making products more expensive. This uncertainty has led the Fed to pause rate cuts, leading to higher borrowing costs and a reduction in the purchase of large, big-ticket items for both businesses and consumers. Finally, a softening job market means higher unemployment and rates reduced customer spending for many Americans. As discretionary income declines, consumers are expected to become more intentional with their purchases, prioritizing essential goods and services. The CEO of Morgan Stanley put it quite eloquently, and shout out to my Morgan Stanley fans over here. At this moment, we don't know what trade policy will settle or what the impact will be, but the consensus among economists is that there will be softer growth this year. That soft growth is immediately impacting retail leaders, as they're the first to make these tough decisions. In their Q1 earnings report, the CEO of Walmart expressed his desire to keep prices as low as possible, but admitted that given the size of tariffs, some of the costs would be passed along to customers. The important thing for marketers like yourself to realize, whether you work in FinServe, retail, or somewhere else, is you are the captain now. You're the ones talking directly to the consumer, deciding what messages to surface and benefits to highlight. You dictate the marketing strategy and influence how consumers engage with your product and program. Ultimately, economic uncertainty demands marketer flexibility. Luckily, marketers have found the port in a storm before. Whether it be the 2008 financial crisis or COVID-19, we know that marketers who best leverage their tech stack to create personalized customer experiences win the day. So what's on the horizon? How will these changes impact consumers? On the whole, it's likely that we'll see some pretty sizable shifts in consumer spend behavior as a result of economic uncertainty. The overall impact, though, will ultimately depend on the size, how big the size of the tariffs are. It's expected that the impact will be felt in these three ways. First and foremost, declining consumer confidence. This is expected to lead to decreased spending and in evolving product preferences for each consumer. Economic uncertainty over tariffs has consumers expecting the worst and preparing for a higher cost of goods. But how will consumers respond? Unsurprisingly, higher costs will lead to decreased spending across the board, with 31% of consumers saying that they would probably prioritize spending on essential items only. FinServ brands need to make sure that they're conveying the value add of their products to ensure that they are top of wallet and when the consumers do spend. Price sensitivity will also be dependent on the type of customers you're talking to. American Express, for example, typically has a more affluent customer base. And as their CEO emphasized in their Q1 earnings call, even though card members say they don't have confidence in the economy, they are still spending. This provides marketers with an opportunity to make an impact. Beyond prioritizing spending on essential items, consumers will be likely to seek out flexible payment options like buy now, pay later that allow them to float purchases over a longer period of time. While tariffs will be most impactful on consumer payments, the continuation of elevated interest rates will lead to banking customers to maximize their earning power by gravitating to high interest savings accounts and CDs. And finally, with stock prices expected to stagnate due to lower sales and higher borrowing costs, retail investors will focus on new asset classes and markets, like treasury bonds, that mitigate the risk exposure of their portfolios. In response to these trade trends and evolving customer preferences, it will be up to you, the captain of the ship, to batten down the hatches and prepare your marketing programs for the new normal. Across the FinServ space, marketers should be focused on three key strategies while engaging their customer base. First, making sure to highlight the value that their product is providing. Second, they should be driving engagement with their core product functionality. And third, they should be deepening relationships with your brand. You should be deepening relationships with your brand via product cross-sell and general thought leadership. So what do these strategies actually look like? Let's start with payments. The average consumer makes 48 payments a month, with credit cards accounting for the largest share of transactions. In the last few years, interest in alternative payment options like buy now, pay later, and peer-to-peer payments have taken off. And in response, banks, fintechs, credit card companies have all expanded their offerings to capture this new share of wallet. But here's the thing. Without the right strategy, it's easy to end up just cannibalizing your share of wallet rather than unlocking new spend. That's where marketers come in. By helping customers understand when and where each payment option is most beneficial, brands can unlock additional spend and product usage, and ultimately stronger results. Let's take a look at how some brands put this into action. Citi credit cards, like many in the industry, have their point accelerators built directly into their value prop of the product, each with varying earning potential based on spend behavior. So I might have 10x on travel, you might have 5x on restaurants, and in their monthly point summary email, Citi acknowledges and thanks each and every one of their customers by emphasizing the additive value that these accelerator categories provide. As Citi cardholders start to scrutinize every dollar spent, the added value being highlighted here will go a long way to protecting that share of wallet that I mentioned before. So protecting share of wallet is nice. It's okay, it's nice, it's table stakes. But diversifying spend and capturing additional share of wallet is even better. One way to achieve this is through timely and relevant messages. Citi used MI to serve up offers that are personalized to each customer at the time of open. Using this customized approach, they were able to drive a 57% lift in offer activation, leading to an increase in spend diversity. However, as consumers start to face tightening budgets, it will be important to deepen the customer relationship by educating them on alternative flexible payment options. FinServe marketers can look to their retail counterparts for inspiration on this very approach. Charlotte Tilbury has set a strong example of this in their abandoned cart emails by highlighting the option to pay later with Klarna directly in the email. They used Movable Inc. to pull in items directly from their shopping cart and automatically calculated the cost per installment that via Klarna that it would cost the customer for each payment, driving a 31% lift in sales. There's a few interesting ways in which payment providers could use this in similar strategies. At the most basic level, if you're a co-brand partner and you're working with airline or hotel or retail co-brand cards, you could be displaying and are already displaying live pricing. You could simply use Movable Inc. to calculate and display the cost per installment on a purchase to make it seem less daunting. Or in the post-purchase journey, you could use payments that you know about and leverage them to show how much to pay that specific payment over time, and promote this in a cross-sell effort to get people to use your additional product functionality. For payments providers, we focused on tariffs, leading to higher costs. But for bank customers, it's all about interest rates and maximizing the earning power. This provides us with a unique opportunity to grow the business in times of economic uncertainty. However, as banking becomes more digital, it also becomes more transactional and less personal. With so little differentiation between providers, customers are spreading their business across multiple institutions. To stand out and capture market share, banks need to only emphasize their competitive rates, but also focus on building real advocacy and deepening relationships. As interest rates rose, Morgan Stanley identified the opportunity to deepen their customer relationships by more heavily promoting their premium savings accounts. To highlight this value, they created a bar chart that directly compared their offer of 4.75% to the industry average of 0.17%. Not only did these visuals help make the offer more digestible, Morgan Stanley is now able to quickly update these creative elements to reflect the most up-to-date rates automatically via ESP merge tags. So, in the future, the next time the Fed makes a rate change, they'll be able to quickly pivot and avoid costly, creative, and operational costs. UK High Street bank Virgin Money, on the other hand, took a different approach and focused on driving existing customers to utilize their savings products and tailoring their communications to future goals. Using MI's live polling capability, they prompted customers to answer a simple question. What's your under savings goal to-do list? Is it short-term or is it long-term? Are you buying a home or are you retiring in style? And based on their response, they were able to send customers timely educational content on the topic that interested them the most, ultimately driving 132% lift in engagement. Though, I do take it a bit personal that there was no saving to buy a boat option in this poll. C'est la vie. Taking this a step further, Ally Bank aims to deepen their customer relationships by reinforcing progress towards established customer goals via dynamic checklists. In this example, the customer has created savings buckets for a housing project, a trip to Hawaii in 2026, and emergency funds. Ally emphasizes the progress towards the customers have made so far and encourages to set time goals as well as progress towards the actual achievement of the goal. And if all goes right, they'll be saying aloha to the beaches of Hawaii in no time. With tariffs fueling volatility in the stock market, tacos aren't just for Tuesday anymore. Every day brings new opportunities, and retail investors are quickly adapting by buying the dip when new sanctions are announced and betting that the measures will be lifted or delayed in the near term. To stay ahead of trends, retail investors must become more agile, shifting their focus to emerging opportunities across asset classes and markets. For wealth management providers, it's a pivotal moment to capture market share by positioning themselves as thought leaders and trusted sources of financial education. To highlight this effective approach of the strategy, we'll explore a case study from Exidity Group, a leading UK-based FX provider demonstrating how innovative strategies can help both investors and advisors thrive in today's dynamic environment. First off, Xfinity's daily trade intelligence email provides educational resources based on the individual's trade signals. Each module is delivered in the language of choice for the recipient and features relevant trading information pulled in via real-time API, with content that includes current and targeted rates, a recommendation confidence bar, and color-coded buy and sell CTAs, all of which are powered by Movable Inc. As our partner at Xfinity put it, if the previous email was telling investors what horse to bet on, this email tells them what race to look at. This daily economic calendar surfaces 4 upcoming investment opportunities for customers by leveraging the same API that I mentioned earlier. This approach encourages customers to explore new markets with the aim of driving deeper engagement with Xfinity. The deeper the engagement, the more loyal the customer. To further drive this loyalty, with Xfinity, like other brands, are focused on emphasizing their product's value. Similar to the Citi example I highlighted earlier, each month they provide customers with a loyalty snapshot of their account, highlighting each customer's current reward multiplier, reward balance, and its corresponding cash value. To take things a step forward, they uniquely emphasize this strategy by gamifying the experience with a dynamic progress tracker. This creative element allows clients to quickly understand the actions that they need to take to elevate their status by showing them how close they are to their next loyalty tier. And in these uncertain economic times, loyal customers are the lifeboat that we're all clamoring for. As previously mentioned, we've weathered storms like this before, but as so long as you highlight your customer value, drive product engagement, and deepen your relationships and educate your customers, X will mark the spot and you'll have engaged customers for the rest of time. Thank you so much, everybody. I'd love to talk to you after the event. Thank you so much.